Hey, folks, I hope you're having a great day out there. So we're going to do over this morning is we're going to go over what the economic headlines are because we're trying to figure out what in the world's going on with mortgage rates and the stock market and everything else. My name is Dan Free. I do this on a daily basis to keep you guys informed of what's going on in real estate, especially the financing part of that puzzle. We focus in on, mortgage guidelines, programs that you might not otherwise be aware of, and where rates are going on a daily basis, because that's a big part of the housing affordability. So what I do on a daily basis is go over the economic news with you guys to give you abreast of what's coming up, what news is relevant, and what news is a bunch of smoke just to divert your attention. So without further ado, let's get over to it. So what you see on my screen on a daily basis is this. And the reason being is, like I said, I'm a mortgage person, so I follow the bond market. So what we're seeing this morning, our 10-year treasuries, they're down 0.04, nothing to write home about there. And then we have the MBS market. The MBS coupon 5.0 is up 11, and the MBS 6.0 is up 0.5. What in the world does that mean? So let's figure this out. So basically what we're focused in on right here is the mortgages. So what we focus in on is the mortgage-backed securities market. It's a bond that trades on Wall Street that you can follow. You might even have it in your portfolio. We focus in on that because it is the bond that trades, that is yield is part of your mortgage rate. So that's how it works. So right here, we're seeing that the MBS market is up. We're at 101.56. You can't see it right here, but if you squint, you can probably see it. It's up 0.02. So basically, it's flat. There's nothing going on with mortgage rates today. We're going to go over the economic calendar here in a second to see if there's any news that came out or that's coming out that might affect that. But one thing that we follow is housing starts. You can see housing starts decreased to 1.42 million annually in March. So what we've been focusing in on is we know existing homes. So there's two pieces of this puzzle when you're looking at houses. There's existing homes, which are houses that are already there that people are living in, and then they put up for sale again. And then there's new homes. So we know existing home sales are way down because they have 3-4% interest rates. They don't want to sell right now because even if they sell and downsize, their payment's going to be higher than what it is today. So we're relying on new construction homes to do that or fill in the void. Well, this isn't good. So if we have housing starts decreasing, that means there's not going to be as many houses on the market. Thus, it's going to continue to be a seller's market. So the good news behind that is you're not going to see a crash because there's limited supply and there's still a good amount of pent-up demand out there. So you're not going to see a huge crash, and you probably won't see a lot of areas even decline much in value unless we have more support there, which means more supply. So that's one thing we're going to really focus in on, and we focus in on this channel. Another thing in this section that I want to focus in on today is we're back to Yahoo Finance, and this was intriguing. Remember, I always say you got to read the headlines and figure out what's going on. If you look here, that one of the headlines they had is more U.S. consumers are falling behind on payments. So the first thing you're going to think is, oh boy, here we go. This is like 2008 again, where we're seeing this big dilemma in the markets and housing crashes and people losing their jobs and falling behind on payments and everything. Well, if you really dig into the details, like I always say, don't judge a book by its cover. Let's go down through the details here and let's just point out some of the sentences in here, and then you tell me if the overall theme of this headline or this website or this article is as doomy or gloomy as you think. So first thing you want to see is right there here, consumers are starting to fall behind on their credit card payments as the economy softens, according to executives at the big U.S. banks. Although they said delinquency levels are still modest. Okay, so they were really good, and then now they ticked up a little bit. So again, it's like foreclosures. When you had a moratorium on foreclosures and basically had almost none, and then you have 10, that's a huge jump from 0 to 10. So in here, if you go from a delinquency level of almost nothing up to 1%, it's a big jump. But in the perspective of things, it's not that big of a deal. Let's keep going through here. Profits of the big banks, and we're going to go over these in a minute, because remember I said there's something up with these big banks, so we're going to go through JP Morgan, Wells Fargo, and Citibank, and Bank of America. We're going to go through their numbers here in a second, and this might really tick you off. Let's keep going. While delinquencies and net charge-offs, debts owed to the bank that is unlikely to be covered, have slowly risen as expected, consumers and businesses generally remain strong. Okay? Delinquency rates were rising as anticipated, but still well below normal levels. Okay, and is there more? The consumer is in great shape in terms of credit quality by the historic standards. Employment remains good, wages remain good, and we haven't seen cracks in our portfolio. So you start going through there, but then you're saying, well, why is there a headline like this? Well, it caught your attention, didn't it? So, but you really read into it and they're saying, okay, it's not so bad out there. So without further ado, let's get over to the economic calendar. Is there something here we should be concerned about today? Well, we had building permits. Previous reading was 1.55 million. They expected to come in at 145 and it came in at 141. Okay, so a little bit of a decline. Not sure why. Was it weather related? Was it whatever? So we're going to take this one reading, but we're going to focus in on the trends here. The next, what we have the rest of the week is Wednesday, crude oil. We're going to monitor that, see what goes on with oil prices because that's a huge piece of the inflation numbers. And then on Thursday, we have initial jobless claims, manufacturing numbers, and existing home sales. So the only really new news out this week that probably is going to shake the market a little bit is Thursdays when we have the jobs numbers, manufacturing numbers, and some numbers on existing, remember guys, existing home sales. Now let's get over to the headlines. Is there anything here we want to see? So let's go down through here. Goldman Sachs misses revenues. Goldman Sachs isn't a bank. They're an investment firm because they lost big on a system they use called Marcus. But here's another thing. Here, Johnson & Johnson, let's see, beats on earnings and revenues, rises its full-year guidance. So you're starting to see a lot of these companies. Remember when we saw Q4 of last year, we saw oil companies come in. And we had record high gas prices, and everybody's complaining, well, there's bottlenecks here, and there's this, and there's that, and this and that. And then we watched the oil companies' earnings, and they blew the roof off. They made more money than they've ever made in history. So now you have all these banks saying, oh, you might want to worry about all these small little regional banks. Protect yourself by going to some of the bigger banks. Well, what's considered the big banks? Okay, so we're going to focus in today on, we got Chase, Bank of America, Citibank, and Wells Fargo. So let's look at their numbers to see, are they really struggling? Are they in fantastic shape? Well, let's go first to Chase. Let's see, Chase's numbers just came out. Their revenues up 23%. Guys, if there's any company's revenues up 23% with a profit margin of 23%, that's huge. I don't know of any industry with a profit margin in revenue growth at this rate right now. So that's alarming, I guess, to say. But if you own stock in JP Morgan Chase, you're going to do pretty well. The next thing is, let's go to Bank of America. So you have Bank of America right here. Let's see where theirs are. Their numbers look like. Revenue up 4%. That's more in line. Net profit margins down a little bit. Let's see where they were previously. They were, look at these numbers in the red over here. The red over here, the red's over here, and then all of a sudden you get to, oh, these are quarterly numbers here. Hold on one second. June of 2023, that's expectations. March, I'm sorry, folks, March. They beat earnings per share by 14%, revenues beat by 4%. So I just want to give you a tune of what's going on here. Revenue, it is March of 2023. It's up 4.22%. Net profit margins, 2.6. How does Chase, right here, how do they have a profit margin of 23% right here? But then you go over to like Citibank and they have a profit margin of 2.6%. Something ain't right here. Okay, so then let's just go one more. Wells Fargo, look at Wells Fargo net profit. Net profit, 28%. Revenues beat. In net income beat. These banks are killing it. And now they come up with, these regional banks, a couple regional banks failed. And some of them, yes, it was on the, bad management and whatever else. But you have to put in context what that bank is there for. It's there for the community. The regional banks are there for the community. So in like Silicon Valley, they were startup companies and stuff like that. Did they make some bad decisions? Maybe they did. Probably they did. They took a little too much risk. But it's consolidating all these banks again. Remember, we didn't want 3 or 4 massive banks in the country, and that was part of the Dodd-Frank bill back in 2010. Well, now all of a sudden what we're seeing in today's world is a flush back to the big banks because regional banks might be insolvent. That they're telling us. So that's something to be really concerned about, folks. So without further ado, let's get over to what the markets are thinking right now that's going to happen with the Federal Reserves. Because in the news every day is the Federal Reserve. What are they going to do? They got to curtail inflation. What's this? What's their next move going to be? And so forth. Well, all we need to do is go to the Chicago options market So here's what the options markets are telling us. These are the futures exchange. What they do is they bet or they predict what's the coming events are going to happen. So what they're saying right now is there's an 85% shot that the Federal Reserve is going to raise rates 1/4% in the May 3rd meeting. Okay. And if they don't do it in that meeting, they will surely do it in one of the other two meetings that are coming up. So between May, June, and July, the Federal Reserve is expected to raise rates 1/4%, just one time, not every time, but one time. And then from there, it looks like the pivot is still kind of on for basically Q3 or Q4 of this year versus, the spin was supposed to be about June of this year. Now it looks like it's going to be August, September-ish timeframe where they might start to cool down. But all this can turn on a dime, folks, depending on what current news is out there right now. So with all that coming in, what in the world's going on with mortgage rates? What we do is we go over to the Trusted Mortgage News Daily. And if you want to get this report, you can subscribe to Mortgage News Daily down below. And you can also subscribe to my newsletter. You're going to get context like this. You're going to get things like this, and you're going to get day-end reports and everything else. So what we're seeing right now is the MBS market is up 8. What that means is all you need to know is when I go across this section, if this number is up, that means the rates are going down. Okay, so we want positive numbers here. The bigger this number is up or down, the bigger the adjustment in rates are. So what's today's rates starting at? Well, let's figure out where we ended yesterday, and this will give us a good tune of what's going to happen today. So according to Mortgage News Daily, the average 30-year term for somebody looking to buy their first house with 20% down and a 740 credit score, let me repeat myself, 740 credit score, purchasing their first house with 20% down. It's a single family home. These are what the rates would be, folks. Okay. So this is a blend of mortgage rates all over the country. So Mortgage News Daily surveys banks all over the country. They send in their responses, then they blend it. Okay, so this isn't truly a rate. This is an average. Okay, so you're seeing here what you have across the board. Yesterday, we saw a little bit of a bump across the board on the 30-year, the long end, and on the short end, we didn't see as much as a bump, but that's what's going on with mortgage rates. So that should conclude my report for today. But if you're out there looking for a mortgage, you need help getting pre-approved, maybe pre-approved for you got a ton of debt. We're seeing people are falling behind on some of their debts. So if that's you, don't struggle. You have probably a lot of built up equity in your house. Maybe look at a home equity loan to consolidate all this debt. I'm not trying to put you in more debt, just trying to make it more feasibly manageable for you guys. And being a good steward of your money, you should look into options that take maybe high interest rate credit cards and put them into a low interest rate loan. Or if you're struggling and you're a senior out there, do you know we offer reverse mortgages, and we do a fantastic job at that, if I say so myself, and I usually work on those personally. So if you're out there looking for a reverse mortgage, please reach out to us. I'd love to talk with you because I handle those personally. Other than that, hope you join us at 3 o'clock today, where I'll answer any questions that you have about the market. We talk about stocks, bonds, cryptocurrencies, and real estate. So I hope you join me at 3 o'clock Central Standard Time to ask any of those questions that you have. So other than that, thanks for watching, guys. God bless. Have a fantastic day, and I'll see you soon. Bye-bye.